Hello and welcome to another Five with Fitz. I'm, of course, Keith Fitz-Gerald, and you're watching the Five with Fitz. Thank you very much for spending a few minutes of your time with me today. You know, there's nothing like a little green on the screen to get the week rolling. Now, to be fair, and as always, I have no idea whether we'll finish that way today, but that's neither here nor there. Nobody does. What we do know, though, is important and potentially super profitable, and that's what you want to focus on. As I noted in last night's Sunday Short, we're heading into the biggest week of earnings season. Chance always favors the prepared, or so goes the old saying, so be prepared. It's not that challenging to think about, but missing opportunity is always more expensive than trying to avoid risks you can't control. So here's my playbook today. Number one, zero doubt, I will buy any big tech induced pullback if we get one this week. I was thrilled to sit down for a great conversation with the super savvy Stuart Varney this morning ahead of today's opening bell. And he asked me two very critical and super on point questions. Number one, are we in the midst of a melt up? And number two, could big tech and the earnings derail the rally? And what am I doing if that happens? Now, you might take my fight. I have rented lips today because I haven't had enough coffee. You might find my take useful. Please watch that video elsewhere on my channel if you'd like. Anyway, speaking of which, number two today, if you're worried about valuations. Now, I get it. A lot of people are, right? And the bubble babble is intense at the moment. It's likely going to reach a crescendo in the weeks ahead. Even so, here's the thing I want you to remember, at least take into consideration. Many critics forget, if they ever knew in the first place, their history. The markets often reward outliers. In fact, high PE ratios often align with extraordinary growth over time, particularly when executives execute and the markets are in transition from one paradigm to another, as is the case right now with AI. And just to prove my point, here are three examples right off the top of my head. Remember Tesla, right? I mean, Tesla traded at PEs that were north of 1,000 from 2020 to 2022, if memory serves. Crazy, right? Yet it delivered over 1,000% returns in the past 5 years. Amazon PEs were between 200 and 300 routinely in the early 2000s, and it had the valuation gang in fits. It's returned something like 70,000% since its IPO. I mean, that's the kind of disgusting valuation that builds empires. Then there's Meta, right? I don't like the stock, but it doesn't change the history. Team Meta, Team Zuck, hit a forward PE of 285 in September 2018, and since then has returned roughly 350%. Now, it's returned from its all-time low, 4,107%. My point is that context is always critical, which is why I often sound like a broken record when it comes to this stuff. Initial losses and low profits or even reduced guidance don't automatically disqualify a high PE stock if growth is ahead. Moats, strategy, quality, time horizon, all of these things matter to you as an investor. Investing isn't a competition, so don't treat it like one. That's a bench level mistake I don't want to see you make. Instead, make investing your journey, your stocks, your tactics, and your results. Why? Because your portfolio will thank you. 100%. Anyway, Keith's investing tip in this department. Many investors are stuck in the past, which is why they're struggling to see the forest for the trees, especially when it comes to valuations. The markets have changed markedly as liquidity and computerization have come on the scene in recent years. So have the listed companies. Anyway, any investor who doesn't understand or adapt is far more likely to get skunked than to succeed. There will be more profits created over the next 10 years than the last 50 combined. And I'd hate to see you miss that. If you're stuck, if you're scared, or you have no idea what to do next, I understand. You're not alone. Change is tough. So let me simply say that I'll be here if you need me. Dun-dun-dun. Superman. Anyway, I love that. I'll be here if you need me. And I mean it. Number three, a rip-your-face-off rally on the horizon? Well, Washington and Beijing are reportedly closing in on a new trade deal as I record this ahead of President Trump's meeting with Chinese President Xi in Seoul this week. Now, that alone is enough to light a fire under markets. Negotiators, of course, have already reached a preliminary consensus, enough to cool talk of 100% tariffs and even hint at a truce over rare earths and soybeans. Now, that is a big and significant step back from the brink and exactly the kind of détente that markets like to see. Now, if Trump and Xi actually seal the deal, even a framework, right? Expect headlines about a rally on renewed optimism faster than you can spell tariff relief. Now, both sides need the win, but Wall Street will take it. Be sure you're on board if that's of interest. Now, funny enough, I told Ashley Webster 2 weeks ago during a media appearance on Fox Business that this could cause a rip-your-face-off rally if Presidents Trump and Xi follow through. And it looks like I might have been onto something, but we'll see. Meanwhile, here's a trading idea in this department. I suspect there will also be an element of buy the rumor, fade the headline when it's announced, meaning that the go fast crew will sell hard and fast short term when the deal's actually announced. Then, of course, they'll load up for the next phase higher. So, putskis, a bet that stocks go down on the NASDAQ and the SPX, could be an interesting speculative choice in the short term if you're into that kind of thing. Number 4, selling a winner too soon will cost you big time. Chances are good that if you've been reading along or watching me on television over the years, you've heard me say more than once, there's no need to switch horses in the middle of a race you're winning. Now, many people let that go in one ear and right out the other. Doing so is an expensive mistake I don't want to see you make. How expensive? Well, funny you ask. Ask Uncle B, as in Warren Buffett. His Berkshire Hathaway is trailing the S&P 500 by the widest margin all year, about 7 points right now as I record this. There's one reason for it: Apple. More specifically, selling Apple too soon. Uncle Warren and company dumped roughly 70% of their stake right before the stock ripped to new highs, leaving, if I have my calculations right, $50 billion, that's billion with a B, on the table. Now, I put an image in the written version of this that drives the point home. But what I want you to think about is this. Trying to outsmart the tape is like trying to catch lightning in a thimble, and even the greats get singed every now and then. I have too over the years. The point I want to make, and I want you to think about, is that the markets have a funny way of rewarding investors who ride all the way to the finish line rather than switching horses mid-race. Number 5 today, Palantir racks up another win. Team Carp just signed a letter of intent with Poland's Ministry of Defense, a move that strengthens its AI-driven defense footprint across NATO's eastern flank. Now, as I noted to the fabulous Liz Clayman on Friday, there's more growth to come. Palantir has returned, and these numbers are astonishing. 325.41%, 2,042.09%, and 1,832.85% over the last 1, 3, and 5-year periods, respectively. The S&P 500, by comparison, has turned in a very respectable 18%, 79%, and 101% over the same time frame, give or take a few percentage points. Anyway, the thing I want you to think about is you got to be in to win, if you actually want to win, that is. Companies like Palantir, love them or hate them, come along once in a blue moon, which is why you want to find them early and latch on when you do. There's no doubt in my mind that you'll have moments when you are questioning what the same heck you were thinking. But those tend to pass over time if you're buying quality, like Palantir. Fear is the market's oldest con, and the markets will always beat that by rewarding knowledge, not guesswork, especially when it comes to finding the next Palantir. And that's where the OBA family really shines. Now, I trust you're thinking the same way. I mean, I really hope so. Why would I say that? Because I learned a long time ago that mindset is an edge that most investors never develop because they're too busy grasping at straws or chasing shiny new stocks. But it's really one that can pay off over time because it represents a huge edge that can help put you on the path to profits and keep you there. As always, I will be here if you need me, by the way. Meanwhile, $200, a target I put on the board a long time ago, is now just a whisper away for Palantir. Hoo-yah! By the way, keep an eye on your email for an important update if you're a member of the OBA family and if you own Palantir. Today's bottom line, you can be an investor or a speculator, just not both simultaneously. Make your choice ahead of time, or the markets will when you least expect it. As always, let's make it a great day and start the week strong. You got this, I promise, and I will see you tomorrow. Thanks for watching.